Ian Fletcher is with us today, and Ian is a senior economist with the Coalition for a Prosperous America. He formerly was a senior fellow at the U.S. Business and Industrial Council, and he's the author of a new book called Free Trade Doesn't Work, What Should Replace It, and why. This is one of those topics that I love about the Writer's Workshop. We get a chance to explore things that, if they're talked about in the media they're only talked about, like immigration is, from one point of view, and everything else is off the table. So, and free trade is very much in this same category. So we're pleased to have Ian with us today to talk about it. Thank you. Give him a little hand here. You're welcome. Do you need slides? Because this is the pointer. Okay.
Hello. As Casey said, I am indeed Ian Fletcher. I'm with Coalition for Prosperous America, which is a nationwide nonpartisan organization dedicated to the reform of America's trade and industrial policies. I'm also the author of the book Free Trade Doesn't Work, and with the co-author, I'm the author of another little booklet, which is outside. There's some free copies on the table, called The Conservative Case Against Free Trade. Now, just to explain something and clue you folks in, we are not an immigration reform organization, so neither my organization nor I personally take any position on the immigration controversy. We are bipartisan. We work with groups from one end of the ideological spectrum to the other. But you might wonder why I'm here talking about free trade. I'd like to begin by pointing out that if you look at America's free trade agreements from NAFTA on down, all these agreements, or almost all of them, have provisions in them which commit the U.S. to issue a certain number of work visas. That is to say, free trade, by way of its legal infrastructure, has become a part of immigration policy. And the argument has already been made when organizations like your own have tried to reduce immigration numbers on Capitol Hill, that the U.S. has treaty commitments that we were committed to have certain levels of immigration. So that's the first reason that I think you folks need to pay attention to free trade as an issue. As I go on, I think you may understand that there are some other connections broadly organized around the issue of economic nationalism. So this is the chart that really brings it home, what the problem with free trade is for this country. This is the U.S. trade deficit. As you can see, the United States for many years had almost balanced trade after World War II till the early 1970s. And then suddenly things have progressively deteriorated and gotten worse and worse and worse. Right now, the U.S. is running a trade deficit of around $500 billion a year. Anyway, what the trade deficit represents is the fact that the U.S. is importing a lot more goods and services than we are exporting. And it's not a small amount of number. It's about $500 billion a year. Now, these are the industries that America has already lost. And as you can see, we have fabless chips, compact fluorescent lighting. You can read the list right over there. Servers, hard disk drives. As you can see, these are not low-end industries. The story that we're told by the establishment media is that when the U.S. engages in free trade with the rest of the world, when we run a trade deficit with the rest of the world, that we're giving up low-end, unsophisticated industries that don't matter. That's not true. And the problem is that you don't just lose your present production when you have a trade deficit. That is, you don't just lose your immediate jobs. You lose entire industries, and when you lose an industry, you're unlikely to get it back. Now, manufacturing, contrary to myth, is not a primitive part of the U.S. economy. There's an image out there which is deliberately cultivated by the people who profit from America's disastrous trade policies that manufacturing is yesterday's news, it's not important, it's primitive, that we're going to have a future of service industries, and that other countries are going to do the world's dirty work, and out of the goodness of their hearts are going to let us specialize in all the lucrative and advanced industries because the rest of the world is just too stupid to figure out that they should be grabbing those industries, don't you know? Well, manufacturing, as these pictures suggest, it's not a primitive part of the economy. Some of you in the audience may work in manufacturing industries, and you may be well aware of this. So this is an example of a myth that's deliberately propagated. Now, when you talk about the trade deficit, a lot of people don't really understand what that is. It's very simple. It's the U.S., when we engage in trade with foreign nations, we import a certain quantity of goods and services from foreign countries, and we export to them. So if we import more than we export, okay, we're getting goods for free, somehow. We're getting stuff we didn't pay for. Now, the way to think this through is like this. When America, it's important to get this basic logic clear, because if you get this clear, you will never be subject to being dazzled by any of the enormous amount of sophistry you see on this issue that's out there. There's one very well-known editorial writer who put in an editorial a couple of years ago, the trade deficit is an, quote, accounting abstraction. And I wrote to him, okay, if it's an accounting abstraction, could you please transfer 10 million units of accounting abstraction from your bank account to mine? Okay? It's real money, folks, okay? We don't get all those Toyotas and all those things from the rest of the world for nothing. The foreign countries, they're not stupid, they're not Santa Claus. So anyway, when we receive, forgive me for being a school teacher here, when we receive goods from abroad, we must pay for those goods either with goods we produce today, goods we produced yesterday, or goods we will produce tomorrow. Now, goods we produce today means that we import Toyotas from Japan and we export Boeing jets to Japan Airlines in exchange for them, okay, and trade balances. Goods we produce yesterday means that we import T-shirts from China and we sell Chinese people shares of Microsoft stock or shares in a limited partnership owning real estate, shopping centers in California, or something like that. Assets accumulated in the past which have value because we produced something in the past. And then goods we produce tomorrow is perhaps the most problematic thing. That means debt. You see, if I borrow money from you or a country borrows money in aggregate from another country, and we promise we're going to pay it back or at least service the debt until we pay it back, that means that if you give us this thing today, we're going to give you something valuable in exchange for that in the future. So, as you can see, there's no way around the fact that when you trade with a foreign country and get stuff from them, you're going to pay for it one way or another eventually. Now, what this means is that when you run a trade deficit, you are either selling off your existing stock of wealth. You're like a family where no one has a job, but you have a house full of great furniture, and you're gradually selling off the furniture to pay the bill. I actually knew a family like that once. They got in early on the mission furniture craze, so they're selling, but you're selling off your existing assets over time. That's not good because every year that goes by, you become poorer from doing this. Equally, you can be sinking into debt. You can be living off your credit cards. And as you can see, if you've got a big credit card credit limit, you can live very well until your credit runs out. And the issue, contrary to some people talk about a sudden crisis, they're suddenly going to run out of money. It's probably not so much an issue of a sudden crisis, though that's not impossible. What it is it's a gradual deterioration in our credit, a gradual increase in the interest rate that we bear, and a gradual diminution of our living standard. Okay? I generally don't like to traffic in crisis scenarios. The way advanced economies generally behave, it's generally not a sudden crisis, though that's certainly not unheard of, as we saw in 2008. What you're really looking at as a result of all these problems is an inexorable deterioration of U.S. living standards. Now, if you recall the chart that we started with, the U.S. had balanced trade for many, many decades. So the question is, what happened? What was it that changed? Now, one of the things you can see, and this is a chart that begins not in 1960, but 1820, is that for most of U.S. history, the U.S. was not a free trade country. There's a myth out there that American history is one big long history of economic liberty and that we've always had the freest economy in the world and that's what makes us great. I'm sorry, but that runs straight into the historic reality that the U.S., the real history of this country is we have exceptional economic freedom domestically, but we also had a tariff that is trade barriers, that is taxes on imports with respect to the rest of the world. Now, what you can see here is for most of American history, tariffs were relatively high and then moderately high. And then in recent times, they go down almost to zero. And the reason for this is the U.S. never decided at some point that we had made a mistake with having a tariff-protected economy. You see, we got started with a protectionist economy right at the Founding Fathers. Alexander Hamilton, if you have a $10 bill on you, you can check him out. He's the guy on the $10 bill. He was one of the most important men in American history who was never president. He was the one Founding Father who was a serious economist. And he basically convinced the other Founding Fathers that if the United States was to become a developed economy, which was a very serious issue for us, because you've got to remember, the U.S. is a third world country in 1776. We're a banana republic with some great ideas about liberty. The world was economically dominated by the large but inward-looking economies of Asia, and particularly by Europe. So if we did not want to remain a subsidiary of the European economy, especially the British economy, supplying them raw materials and buying manufactured goods from them, which would guarantee us a subordinate place in the world, we were going to have a tariff-protected economy so we could develop our own economy. And this is what Alexander Hamilton told all the other Founding Fathers, and they agreed with him. And as I showed in the chart that we just had of the U.S. tariff, historically, for most of American history, that is what we did. And this is not just an American thing. In fact, in the history of the world, there is no example of an industrialized, developed country that became that way on the basis of free trade. Not if you look at England in the 17th century, not if you look at South Korea in the 21st century. There's no exception to that. You don't become a developed country practicing free trade. You become or practicing laissez-faire domestically. You become a developed country practicing protectionism and industrial policy. Most of the industrial policy is what you do in your domestic economy to become a developed country. That's not my topic today. But it's important to understand the U.S. didn't become what it became by accident. This was caused to happen by deliberate policies that started with Hamilton. And this continues through American history. Abraham Lincoln's #2 issue after slavery was the tariff. And there's an interesting correspondence during the Civil War between Abraham Lincoln and a gentleman called Henry Carey, who was a Philadelphia economist and one of the leading economists of his day. He's constantly talking to Abraham Lincoln, can we talk about the tariff? And Lincoln is like, no, I got to win this war, and so forth. So they're going back and forth. But this was well understood, particularly on the Republican side. One of the ironies is that the Republican Party has become the most fanatical for free trade. Historically, protectionism is the Republican economic principle. In the 1890s, when Mark Hanna, who was a U.S. Senator from Ohio and is an individual that you may know if you know your American history, he basically created the modern Republican Party, in which they had a mass economic appeal to the working class, and they said, we're going to use the tariff to protect your wages from cheap labor competition from Europe at the time was the issue. And one of the reasons, as I've written in my column, which appears in the WorldNet Daily and Huffington Post, Mitt Romney had a great opportunity as a Republican to turn towards this kind of economic nationalism, which is the historic Republican position. It looks so far that he's adopted it in such an incredibly tepid way, with both his relatively mild opposition to immigration and his relatively mild opposition, for example, to what China is doing to us, that his appeal just hasn't been strong enough. I think that was a winning move. I think that is historically the winning move of the Republican Party. It's not economic globalism, it's economic nationalism, and it has very deep roots in American history. Now, one of the things that's another myth, I was talking about myths before, is that the U.S. is just, here we are, we're right here. And if you can't read this, this says hourly compensation costs in manufacturing U.S. dollars. And this is Norway, Denmark, Belgium, Austria, Germany, Switzerland, Finland, Netherlands, France, Sweden, Ireland, Italy, Australia. Then we have the U.S. Point is, the U.S. is not just losing in international competition and international trade to cheap labor countries. Cheap foreign labor is an enormous part of the problem. It's the part of the problem that I usually lead with when talking to people because people understand it easily. But what's actually far more damning, in my view, of U.S. policy is that we're actually losing out to a lot of countries that do pay their workers decently. And many of these countries that are above us in terms of their wage rates, these are countries that are running trade surpluses against us. I mean, Germany, for example, they pay their manufacturing workers much better than we pay ours, and they run a huge trade surplus against the United States because they're more productive. They have, they don't have an auto industry, for example, that's in the throes of bankruptcy. And they have a lot of other policies so that they don't run a trade deficit with their trading partners. None of this stuff happened inevitably. None of it happened by accident. I mean, that's another huge myth to get around. You all know that on your own area of policy, immigration doesn't just happen. It happens because the government passes certain laws and adopts certain policies and make it happen. I got the exact same message. It works the exact same way. All the problems the U.S. has with trade are the results of identifiable policy choices that the U.S. has made. The biggest myth in the world, I think, since ancient Babylon down to the present day, is the idea that the social and political order and the problems in it are inevitable. This stuff just happened, folks. So don't you worry about it. Don't you go looking for anybody to blame. And certainly don't you try and change anything. Now, here we get to another issue the U.S. is dealing with. I mentioned before that we have this myth that America is historically the land of absolute laissez-faire. And that's not true in American history. It wasn't true when Abraham Lincoln set up land-grant colleges. It wasn't true when the government subsidized the Transcontinental Railroad. It wasn't true when the government applied a tariff on foreign imports. It wasn't true when the government paid to set up the Internet. But what the U.S. has historically had is we've had a great deal of economic freedom with very limited but strategically important constraints on that to push our economy in the direction of a high-wage middle-class society. Most of our economy, there was no government interference, but the strategic interventions the government made were very important, and they produced the results that, until recently, we could know and love. The U.S. today is in competition with a very different kind of capitalism. See, in the U.S., despite the fact that we have historically had, as I said, strategic intervention in our economy, capital is allocated by the private market. So we have our beloved New York Stock Exchange down here. Now, other countries don't have the same traditions of liberty that we have, so they don't go at the problem of developing their economy from the attitude of, we take freedom as our first principle, and then we have to make certain strategic modifications to that because we're not libertarian fanatics, but we know we have to do certain things in order to get the middle-class society we want, and we're not going to do more than we have to. Other countries, starting with China, don't really care about freedom at all, so they have state capitalism as opposed to free market capitalism. And the Chinese do this in a very authoritarian, non-democratic, quasi-fascist sort of way. And the Japanese do it in a very polite, quasi-democratic, sort of kid gloves sort of way. By the way, Japan's economy is doing much better than almost anybody realizes. There's a myth out there that Japan is an economic basket case. If you look at the official figures for how they're doing over the last 10 years, their economic growth is within, I think, 0.2% of our own. So it's a myth that Japan is a disaster area, which is why I'm using them as an example of a dangerous and successful rival here. Even if you take the official figures, which I don't think are accurate for reasons I'd be happy to talk about some other time, Japan is still the second richest country in the world, and China is the world's second largest economy. Now, I put these buildings on the screen, the Ministry of Commerce in Beijing and the Ministry of Finance in Tokyo, to make clear that when I talk about state capitalism, there really are government institutions with real people in real buildings with real legal authority running these economies. These economies have private companies, private individuals, and private profit, but they are fundamentally under the government's thumb, and they are directed to do what the government wants them to do. I don't have the time here to go into the details of this, but the fact is that when China decides they want to get into a certain industry, for example, when the Chinese government has decided that they want to have a strong position in the large airliner market, or when Japan in decades in the past made this decision. You don't have entrepreneurs raising capital in private capital markets to do this. You have government saying, we control the banking system, and we're going to tell our banks, this is where you'll invest. You can tell our universities, this is what you train people to do. And you tell our distribution system, you have to buy your products from these companies in order to make this happen. Now, you can laugh at all this, and you're going to talk to Wall Street Journal, the Cato Institute, any of those guys. This is impossible. Japan could not have succeeded this way. Neither could South Korea, Taiwan, Singapore, Hong Kong, etc. And China certainly can't be succeeding with a state-directed economy. That's impossible on theoretical grounds. Now, I assume I don't have to tell any of you here how fast their economy has been growing for the last 30 years. It is simply not true that laissez-faire is the only way to go. That contradicts the observed reality of the present-day world, and to a significant extent, it even contradicts our own American history. Now, the bottom line on this stuff is that state capitalism means that part of their strategy of building up their economy is to run trade surpluses against us. So the United States is in the position of confronting foreign nations that have a very deliberately organized economic strategy when we really don't. And as a result, they can dominate us very easily because we aren't even trying to fight back. It's not like we have an economic strategy of our own and we're going up against them in the ring and they've just got, bigger fists than we have and they beat us. We're not even trying. We're operating on this kind of Wall Street Journal assumption that you can't win with deliberate economic strategy, that anything the government does in the economic arena is necessarily going to be wrong and a failure, so we don't have to worry about these guys. By the way, all of you know, if you read publications like Wall Street Journal, The Economist, and so forth, I assume you guys all know where they stand on your own issue. So I strongly suggest that you bear that in mind when assessing their credibility on other issues. These publications and the associated institutions that provide their intellectual capital, whether you're talking about, Cato Institute, Reason Foundation, you name it, these guys, they're de facto globalists. They are truly interested in serving the interests of certain economic constituencies that fund them, and the ideological frame that they adopt in order to justify how they can do this and still claim to be good Americans is globalism. They believe that this is all magically in America's interests, and it's just not working out that way. I think the time is gradually running out on these people. But it's a question of how long it's going to take. That I can't predict. Now, in terms of what ought to be done about this, the first thing the U.S. needs to do, just legislatively, is that there's been a bill in Congress for some time about Chinese currency manipulation. The fact is that a lot of countries around the world manipulate the value of their currency. China is the worst offender. When you artificially push down the value of your currency, you make exports artificially cheap, so you boost your trade surplus in that way. And the way this is done, just so that there's no mystery here, and there's no serious controversy that they're doing it. They're even documented as having said they're doing it, if you know where to look and if you have people who can translate the Chinese sources for you, is the demand for a nation's currency is a product of supply and demand, like the price of anything else, which means that the demand for dollars is a function of how many people want to buy goods that are sold for dollars. Now, the problem is that things that are sold for dollars doesn't just mean goods and services. It also means debt and assets. So if you, for example, rig your financial system, which China does, so that when exporters from China earn dollars, they can't do what they like with them. They have to hand them over to a bank controlled by the Chinese government, which it's their money, but they have to put it in a Chinese-controlled bank. And then this bank takes those dollars and uses them to buy U.S. debt and assets rather than U.S. goods. Now that gets us back to the three cases I talked about before of goods we produce today, goods we produce tomorrow, goods we produced yesterday, which systematically pushes the U.S. into a deficit condition. Now, the Republican leadership on the Hill has been backing up this China currency bill. So that's the first thing we should do. In terms of where we can go from there, in terms of the larger picture, The number one priority would be to zero out the U.S. trade deficit, because when you have $500 billion a year of demand going overseas, that's a major reason why our economy is not recovering from recession, because it means when Americans spend money, that money is not recirculated into our own economy. It goes someplace else and stimulates somebody else's economy. So, as I mentioned, I had hopes for Mitt Romney at one point that he was turning seriously towards an economic nationalist agenda. I think the evidence is that he's turned towards that in a very weak, tepid, and uncertain way. I don't even know if the guy means it. He said he's going to crack down on Chinese currency manipulation, for example, but he declines to endorse the bill which is bottled up by the Republican leadership. Maybe he is refraining from doing so because he doesn't want to pick a fight with Boehner, and it's inappropriate to fight with the leadership of his own party in the middle of a presidential election. I don't know, but I do know that what he's done has been very, very tepid. On Obama's side, I can tell you that he talked a good line on this stuff at the time of the Pennsylvania and Ohio Democratic primaries when he was getting elected. Since then, he has not really done anything. He's made some nice little symbolic gestures in terms of raising complaints with the World Trade Organization, most recently on automobiles. But basically, these guys are so close to one another on this issue that I and the organization that I represent really can't choose between them unless something really explosive happens between now and the election. Maybe it will. Anyhow, that's my presentation. I'd like to open the floor to questions, if anybody has any. Does anyone have questions? Please, in the back. Okay, let me restate the gentleman's question for those who may have been confused. What he's basically asking is, he says, okay, we're like a family, the U.S. is, that's going massively into debt. We've got more and more debt. Now, if you were a family or an individual that's going into more and more debt, as you become more indebted, you become a inferior credit risk. So your creditors, people are going to lend you money, you would expect them to demand a higher interest rate as compensation for lending to a more shaky customer here. So the question then is, okay, if this is the way it works, why is the U.S. Currently looking at record low interest rates? There's no mystery about this. As I pointed out when I discussed currency manipulation, the way that foreign countries manipulate their currencies, and China is the worst offender, but they're not the only ones doing this, is they have their financial systems, their banks and so forth, rigged so that when they earn dollars from us by selling us goods and services, those dollars don't flow back to us to buy goods and services from us. They flow back to us in the form of buying assets and debt. Because the dollars are going to come back some way, unless they're going to stick them under the mattress. But you don't have to spend that money on buying, Ford F-150 pickup trucks, container loads of that, or Boeing airplanes or soybeans or whatever. You can buy U.S. Treasury bills or shares of IBM and so forth. Now, when you have the system artificially rigged so that these hundreds of billions of dollars are going into buying debt, well, what happens when you buy a lot of debt, when you have a huge flow of capital into the debt market? Well, it's like anything else with supply and demand. You drive down the price, which means you drive down interest rates. So the reason interest rates are so low is because you have this massive international undertaking on the part of all the trade surplus countries in the world, which I remind you, their net trade surpluses add up to our net trade deficit. So it's $500 billion a year. It's not a small amount of money. They're all artificially pushing their money into debt, which is why there's so much cheap capital in circulation. I hope that makes sense to you all. Any other questions?
Okay. I'm sorry,
we're running late. Thank you very much.